Conversation and a look at what the Bank of Canada's actions will mean for oil, the loonie, as well as investors. We've got Som Seif. He's the CEO of Purpose Investments joining us now. Som, good to see you. Thanks for joining us.
Great to be here, Catherine.
I think there's been a ton that's gone on since the last time you and I sat down with each other. And of course, the most recent and perhaps the most dramatic, besides the price of oil, is the Bank of Canada. What do you make of all this?
Well, I mean, I think that the Bank of Canada had very little option but to do this. I mean, if you look at what's happened in the last couple of weeks, I mean, we've been talking about this for years, about the potential for currency wars, and all of a sudden now it's sort of become this, reality. I mean, it's happening quickly. It's been going on for a while, but now it's starting to see this race to the bottom that everyone, the beggar thy neighbor in many respects, and everybody's been moving. When Switzerland cut its rate to negative rates, and when you see Norway doing the same, Canada sitting here at a 1% rate, it really has very little option but to cut rates because ultimately you're in a situation that you may look like, despite your declining price, one of the better regions to put capital at work. And so, money may start flowing here and moving the loonie upwards. So I think that this was a logical move. It also, given the offsets, the pressure that oil was providing, it gives a little bit of sort of offset some of the pressure on the economy this way to increase the manufacturing segment of the market.
Som, I'm just wondering, though, being the better place to invest isn't a bad thing. So I'm not sure I understand why that's the right argument to lower the currency.
In an environment where we're all vying for growth, what people are doing is effectively reducing their cost of exporting. So they become a more attractive exporting region to increase, stimulate the economy. And so if everyone else's currencies are getting cheaper and Canada looks, starts to stabilize or go up,
right,
what ends up happening is that Canada starts to become a less competitive market for exporting, which reduces our potential upside for, stimulating the economy. And that's the biggest issue. That's what Europe's doing. That's what the Japanese have been doing. That's what effectively China's been doing by pegging its currency to the U.S. for many, many decades. So this is a huge issue that every currency around the world is dealing with, and you don't want to be on the other side of this, the way the U.S. is right now.
You don't want to be on the other side of it, but at the same time, too, I wonder if it isn't a little bit different for Canada, because our largest trading partner is the United States, and they are having a stronger economy and a stronger dollar. So why do we need to be as aggressive as the central bankers of China, Japan, and Europe? Why do we need to do that?
Because just very simply, all of a sudden, Canada, it looks, in the last year, Canada looks 20% cheaper even to the Americans. And so from their perspective, they're going to look at Canada as a more attractive option versus looking at Europe, looking at Japan. Because remember, we're all fighting in a global economy for exporting our goods to the largest economies, being the U.S. primarily, and then Europe and Japan and other markets. And so everyone's fighting for this. And so if we don't look competitive, our products just won't sell off the shelf.
So how do you think our viewers should be looking at these major moves that, quite frankly, whether you're in the market or you're running a business or you're doing something else in your life, people are still trying to figure out, and I don't think anybody has great answers. I mean, you're giving us some of the answers. I hear you, but what do you think of when you're sitting at home?
Well, I mean, very simply, if you're sitting here as a Canadian, your purchasing power has just been reduced. You're booking your next trip to the U.S. You're looking at buying a new car. All these things are getting more expensive for the most part because we're importing those things to our country. So for us, it has a meaningful impact. If you're a company who is importing or exporting goods, the NHL, I mean, these are all places that have a huge impact by the Canadian dollar declining. But at the end of the day, here's the reality. We have to recognize this is happening. Momentum is moving against us. Canadian dollar is likely moving lower from this point. I would, if you'd asked me 6 months ago, I thought the low point for the Canadian dollar would have been at 83, 84 cents. Now I'm thinking in the sort of high 70s or potentially mid 70s, like we're hearing other people talk about. So the momentum will overshoot its fair value. Whether or not you think it's fair value, it will overshoot its fair value.
What about oil? It felt earlier in the day we were getting a little, because that's clearly part of the conversation, and that's the reason why the Bank of Canada did in fact cut rates is the declining price of oil. It looked as though it was stabilizing this morning. Not such the case right now. What do you think?
Well, look, I mean, oil is going to have a long time to stabilize here. We have to figure out whether is $45, $48 going to be our stable levels. Are we going in sub-40s into the 30s and potentially even to the 20s? I mean, as crazy as that sounds, we need to be thoughtful about that. If you're managing a business or an investment portfolio, you need to be thinking about stress testing for those types of scenarios. Maybe they'll never happen, but you need to be thoughtful about them. The reality is, oil is declining. It's in a momentum phase right now. And this is a supply side issue. We know that. It's not a demand side like 2008 and 99, which we'll see a quick recovery. This is going to be supply side. And until we start to see companies truly start cutting production, we're going to see a little bit of a lack of stability.
Some, you used a word that I think is really important for viewers to know, that when you're looking at commodities, there can be very, very strong momentum behind the moves, not only in commodities, but now we're also seeing it and experiencing it in foreign exchange markets as well.
Well, and commodities are much more volatile than FX currency is historically. In the last couple of weeks, we've seen a lot of crazy moves like the Swiss and Norway and well-known news like the ECB's move, but the big moves. These are meaningful moves. And so in commodity side, the same thing. But generally, assets are emotional, and so they're driven by momentum, both on the upside and on the downside. Equity markets have them, and so markets generally will overshoot their fair value on the upside and undershoot their fair value on the downside just because of this emotional market. Absolutely.
All right, coming up, Som is going to be staying with us for a look at how investors should be positioning themselves in this falling rate environment. Stay with us.